I only trade one 4-hour candle a day and still manage to make over $500 a day. And the simple purpose of understanding this concept is to allow you guys to take advantage of impulsive markets. On our previous video, we spoke about the candle range video, which we use in ranging markets. However, as I've studied this 1 4-hour candle for the last 4 years, I've realized that it can do one of two things, either range or impulse. And I'll teach you guys today how to take advantage of the continuation of this 4-hour candle. Now, we only have two scenarios that we're looking for every single day. We mark out our 4-hour 5 AM candle high and low point. When price pushes above, we're looking to buy and continue the trend upward. However, price continues to go down lower, we will then look to sell on that specific day. How does this truly work? It is simply based off of your 1 4-hour candle close. This is a bullish candle, so this is the 4-hour close, and this is a bearish candle, so this is the 4-hour close. Now, we first also have to understand the candle anatomy of each and every single candle. Firstly, you have to understand that every higher time frame candle is a lower time frame movement. For a bullish candle, once price opens, we start off that candle with a ranging move. We then manipulate to create the low of that session. We then distribute to create the high of that session. And then later on, we then start to lose a bit more volatility as we come to the closing hour of that candle. And the same goes with a bearish candle, but on a simpler framework. We consolidate, we manipulate, and then we distribute lower, and then start to exhaust price and then close. This is our 1 candle mechanics. I've created this new model to take advantage of days when price looks to impulse up higher. Extending from our candle anatomy, we have to understand we have our previous candle and our current candle that we're trading for that exact day. And as you can see, there is a transfer of price action. Price comes towards the closing hour. For instance, this is 9:59, 1 minute before 10 AM, and then we start to create the new candle. And this same exact candle anatomy is then extended to the next candle. Price then consolidates as it opens up the new price range. It then manipulates and then distributes and then closes off, and then the cycle repeats itself. But by understanding this, you guys can take advantage of every single impulsive candle by focusing on your previous candle close, PCC. Price closes at this area and opens at the exact same area. Once we dip below, we're looking to buy up higher. As we said, we look to buy below the closing price and we look to sell above the closing price for a bearish example. And as you can see, the same thing goes. We are waiting for that retracement of price. We then look to buy up within here. And within this area, you'll then be able to find lower time frame demand zones or fair value gaps that you can use to support your bullish claims for the day, as well as for your bearish supply zone and bearish FEGs that allow price to then distribute lower. And as you can see, we then extend this high time frame candle, but with a lower time frame price movement. As price pushes and closes to make this candle, and then starts with the new candle with a first retracement and then an impulse. This is simply an enhanced impulse and retracement model. Price pushes lower, retraces, and then continues to push lower. It is by simple market design. As you can see with this, as price distributes lower and then starts to move up higher, it then creates the wick. Now, this is the key important factor of this entire model. We are looking to enter within the wick of the candle, and then we're looking to distribute and target higher as the price high time frame candle distributes. Same with our bearish example. As we make that 4-hour wick, we're then looking to trade with the distribution of that bearish candle. And this introduces the true fractality of the market. However, in basic terms, this is, as I said, a new retracement model, which makes use of your Fibonacci. Now, these are the 3 main important levels that will create your quarters of your higher time frame candle. For a bearish movement, you want to have your 25%, 50%, and 75%. And you want to make sure as price retraces, it stays within the lower quarter of that price range, below the 40% and below the 25% within this area, because within an impulsive market, you're not looking for price to make deep retracements. You're instead looking for very short retracements that allows price to just quickly push away. And the same is said for a bullish continuation. You're looking for price to have a very shallow retracement being above your 40% and within your upper quarter, which is the 25% and 50%. And you're looking for that wick to then distribute higher. Now let's see the animation of this. This is our previous candle and this is our current candle. It starts off with that flat lining where price is just consolidating above and below the previous candle's close. you're looking for price for a bullish example to fall within your upper quarter, which is the 25% and 50% level. As we then start to create this bearish candle distribution, you will then notice prices now falling down on the lower time frame. We are then seeing price retracing to demand zones, FEGs, where you can then look to start entering your positions, and then price then starts to distribute where you have already entered within the wick of that current candle, and you're profiting off of the impulsive move. This is the true understanding behind our CIT model. Now here's a few tips to further enhance this trading strategy. In a bullish example, you want to be below your midnight and 8:30 open, and for a bearish example, you want to be above your midnight and 8:30 open as extra confluence. As you can see right here, here's your midnight opening and there's your 8:30. If you're also below that in regard with the PCC, you're then in the best discount for price to push up higher aggressively. Now, how do we exactly enter this? As I stated previously, we're looking for when price is retracing, for a bullish example, below your PCC and then coming to demand zones. And even more so, you can then also use liquidation models that I teach exclusively to my students. However, the basic one you can always take advantage of is your turtle swoop, where price takes out a previous short-term low and then looks to extend higher. This is the prime model you want to be using, especially for this model. And then the second one is just your normal AMD or power of 3. You want to look for your accumulation, manipulation, and distribution of price, as I previously showed you, where price is then starting off with the opening, manipulating, then you're looking to enter within that distribution to target lower. Now, let's go over some quick things. What is the best time to trade this? It is from 9 AM Eastern Standard Time to 11 AM Eastern Standard Time during your New York AM session. The best market conditions to trade this is in the name, candle impulse theory. So you're trading this within impulsive markets. This is an example of an impulsive market where price is shooting downward, and you can take advantage of every single candle that price prints after this. As here's your previous candle close, price wicks up and then it distributes lower. Price closes, wicks up and then distributes lower. Every single wick up, you are taking advantage of that move. And the best assets / pairs to trade this is my personal favorite, my personal ones that I trade. It is gold and Nasdaq, and these are highly impulsive pairs. And then the rest that my other students trade is BTC. All of these work on various amounts of assets. Now let's take a look at a trade example we took this week. That's over $500 for the day. That took live with our students. So this is an example of the first trade we took this week. Now, to make your life a lot easier when you use this model, you want to get out this indicator called the TTM higher time frame candle overlay power 3. And all this really does is just marks out your current 4-hour candles. And this is our most latest 4-hour candle. As you can see, it marks out the high, and the low perfectly. However, our main focus is going to be that candle close. We're just going to leave our area right over there. And then we also want to get out our Gann box that has our levels. So doing that from the high or the low, as you can see, we have now extended our upper quarters right over here, and we want to see price stay within here, wick down, and then push up higher. That's how we will take advantage of the upcoming impulsive move, as this is an impulsive candle. We're now going to the lower time frame. As you can currently see that I'm also using UTC -5 on my chart. So we're going to play out the price here. You can see now we're currently making the wick of that candle there. Now, as we come back into this area, we now identify we have a turtle swoop. The price takes out this most recent low. Following the market structure, we can see that we're pushing high, made a high low, pushed up high, broke the high low. That's what we look for. Now I'm looking for a change in state of delivery, our normal inchy models, which you do get right over here. Price closes above this area, and this is when I spoke to all the members in the live stream that we're going to look to enter gold at this area. We had our stop loss around somewhere around these lows here, and then we targeted using our Fibonacci extension levels at the max extension. And this is our current trade, and this is at 11:20. Lovely, just within our time range. You can just see, look at that candle moving now. This 9 AM candle has already been fully extended, but we still see price action is moving higher now, and you can just take advantage of looking at how those candles are moving. They're wicking lower. It's also a very great example. Price opens here, wicks lower, and then starts to push up higher distribution. As you can see, this is our trade on here on gold. Very beautiful position. And then price keeps on extending higher. Look what price did. It opened up, consolidating. It then wicked down to manipulate, creating the wick, right? And then we distributed. And now as this kind of closes, should start to consolidate once again. And there we go. As you start with the new candle, what price does, it consolidates once again. Our one candle mechanics. Now let's move on to our next example on Nasdaq. So the exact same procedure on Nasdaq. We have for our candle, we mark out that previous candle closing price here, and then we also want to mark out our range. Also want to mark out our quarters for this candle. Remember, looking for price to fall in this exact area. And then go down to the lower time frame now, and then you play for a price. What we are looking for is a liquidation. What we're looking for is a price to move lower back into this area, which we do get right over here as price total swoops this low. This wick over here, price sweeps that out. Want to see if price can change its state right now. Price does a change in its delivery, and then now we can look to enter with this trade over here. Starts to low this low here. Target the highs, okay. And Fibonacci at TP and then stop loss. Then letting price play out. Focus on the candle. There we go. And there you have taken advantage of that entire impulse that price created within this price range. And as you can see, these also emanated live examples onto our trading Discord. And if you would like to join that, you can firstly book a free call with me, or you can also just get our free course, which is within the link in the description. And now that you guys understand how to use it on the 4-hour candle, you can also look at this video where you can learn how to master this concept on your daily time frame to perfect your daily buys. Gonna happen after that. But Nasdaq, I think it's probably doing this because it wants to do something around the New York PM session with the FOMC, I'm pretty sure. Gold,